Hey, good morning, everyone, and Leaving California World. I'm David Barry. I'm your host of Money Matters. This is episode 13. And my goodness, Monty, you talk about news from having a war in the Middle East to
Mm.
having a hurricane down where Terry is to the Fed. I actually heard a rumor that they might have an emergency rate cut. I mean, there is so much going on. So you tuned into the right show. Monty,
Mm.
what are we going to talk about today? This might be a little bit longer show than normal. What's happening, Monty?
It could be. I'm very excited to share what this is going to mean for our listeners. Some good things are happening, really, really good things. It's going to have positive impacts. The main highlights, what we're going to cover today, is that the Fed holds those rates steady, but they're hinting about that September rate cut. We finally got the weak jobs report for July. That's more indicative of the real picture that we've been saying. Hey, the real jobs picture is this. The private payrolls, we got those too. We'll talk about those in a little bit. Those hit the lowest level since January. And then home prices hit a new record high. So all of that together, mixed with the headline that rates are now better than they have been in all of 2024. We've now moved backwards. This is going to be a great show.
And by the way, I heard that I'm hearing inklings of they're encouraging people that if they really are thinking about selling their house, that now's the time because they feel that home prices might be dropping. So there might be some mixed messages out there, but I've been seeing some of that as well. If you want to get the top dollar, now's a good time to sell. And if you're looking to, because you got a bigger family now, maybe. But let's not forget Terry. He's down there in the middle of a hurricane. What's going on in Florida?
Oh, little wind, little rain. It's okay. I'm inland. My house was built for it. In fact, this house I'm in has been through probably 10 to 12 hurricanes, so no big deal. You just don't want the trees to fall. That's the one thing you really want to avoid. But no, everything's great down here. I feel for those in the Panhandle who are really having a rough time right now. But that's you get that when you move to Florida and just look past it.
Well, Monty, you know that come rain, come shine, come hurricane, money matters. It doesn't matter what's going on in the world of politics, in the world of money, in the world in our world. And I'm kind of maybe I'm a little all over the place, but there's just so much going on. And Monty is so structured. And Monty, let's do little chops of this. Go ahead. Where do we start?
Yeah, well, I want to start with the Fed and the meeting that they had last week. They hold those rates steady, but they're hinting about that September rate cut. After 11 rate hikes since March of 2022, the Fed once again left that benchmark federal funds rate unchanged at the range of 5.25% to 5.5%. That decision was unanimous and marks the eighth straight meeting where they held rates steady. Now, the Fed funds rate is that interest rate for overnight borrowing for banks. It is not the same thing as mortgage rates. The Fed has been aggressively hiking that Fed funds rate throughout this cycle to try to slow down the economy, curb the runaway inflation that became rampant over the last few years. So, what's the bottom line? The bottom line is that cooling consumer inflation, combined with the signs that the economy and the job market are now finally slowing down, that has led to the growing calls for the Fed to begin cutting that benchmark Fed funds rate. Now, Fed Chair Jerome Powell did not commit to a rate cut at the next meeting, September 17th and 18th. He didn't do that. He said that the Fed thinks that the time is approaching. And if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting. We all know Jerome Powell is an attorney, and he is not going to tell you what you want to hear.
Got it.
So
Got it.
that's the big thing. We're all still on track. We still believe we are in right where we need to be for that meeting.
Well,
And this was their intent. I'm sorry, this was their intent the entire time. Their goal has been, since they've been raising rates, is to slow the economy so inflation slows. Is that correct?
Yeah.
And now we're seeing that happen.
Right.
And to put people out of work. And unfortunately, and he even admitted that, didn't he, Monty? He said that we're going to have people are going to lose their jobs to save the economy. And that's really a shame. But is that the
Well,
case?
yes, and we know that's been going on. See, I think that's where the Fed has been saying that jobs are not going down, that we have a strong labor market right now. We've known that was not true. And so The second thing that we want to highlight was that weak July jobs report was more indicative of what we've believed the real picture was all along. That report, we often use the BLS, that Bureau of Labor Statistics. That reported that there were 114,000 jobs created in July, which was well below the estimates of 175,000. Those negative revisions that they always make, they made them to May and June. That shaved off 29,000 jobs from those months combined. So the unemployment rate rose from 4.1% to 4.3%, which is the highest level since October of 2021.
Wow.
Crazy, I know.
Well, here's the thing, and I'm really glad that I have you on the show with us for our members. I understand that even though the Fed didn't change anything, that rates are coming down. So how does that happen, Monty? And what does that mean for our people that are looking to sell their home and move to a new community?
Yeah, well, it's good news. I feel like it's a siren before a tornado, though, also at the same time. So although it's a good and exciting, it also is a siren to tell you you need to make some changes. There's a storm coming, a good storm in a way, but it's still a storm. And you don't want to get caught up in a storm like Terry is, even if it's not going to destroy your house. It may create chaos. And so we've used that statistic in the past. We want to remind you of it again today. When rates drop a whole percent, when they drop a whole percent, 5 million new buyers come into the market looking for a house. Just in the past 2 weeks, we've seen the rate drop more than 0.5%. So we are more than halfway. We are 0.6%, I would say, at least, if not 0.7% already to that mark. So I know that this week will be busy for me. The phones are going to start ringing more and more and more. So if you're thinking about selling your house and moving, you need to seriously talk to one of the realtors that we know who aren't going to get messed up by the influx of calls, and they're going to give you great treatment, talk to you about what your house is really worth in this market, because this is a different market than it was 2 weeks ago. And then where can you go buy? What are the opportunities there to get a better rate? I was telling y'all before we started the call, I've been able to give people 0.5% or 0.75% better interest rates in the past 2 weeks than they would have had if they would have bought last month.
Well, Monty,
that brings up, let me just bring up that point to that. Monty, that also includes people who aren't necessarily leaving California yet, right? You can help people who have high interest rates refinance their mortgage. And whether they do it at no cost or they pay down points or whatever, for those who are looking to not to leave for the next 3 to 5 years, this would be a great time. If you've got a high interest rate, give Monty a call. He can do refinances too. He's not just available for purchase business, but he's also available for refinances. People should be aware of that, and they can certainly reach out to Monty, if not just to establish a relationship so that he can track it, so he can let you know, hey, look, you're not leaving for a couple of years. Let's go ahead and refinance you into a much lower rate and get you a much better monthly payment.
Yeah, if you bought in the last 2 years, you probably have a rate in the high 6s or maybe somewhere in the 7s, could even be the 8s. Veterans are the ones I really want to make a big call to. Veterans, we can do a VA IRRL, that is a interest rate reduction refinance loan. It's a streamline. We don't need your income documents. It is so easy. And those we're pushing down into the high 5s at this point. Even the mid 5s, I expect now with these rates going down. So please, if you're a veteran, if you know a veteran, yes, let me refinance your loan and save you hundreds of dollars.
Monty, I was kind of along the lines of the question I'm asking for myself, and I'm asking for all of our members, because it is a little confusing and it's hard to keep track of all this. How does that work? Because for most of our members, they probably think that the interest rate is tied to whatever the government says the rates need to be. But how much flexibility do the banks have to be able to lower the rates? Because they're lowering the rates, but the rates didn't come down. Can you explain that a little bit?
Yeah, so the Fed funds rate is what they're changing. They're talking about doing a rate cut there. You've got mortgage-backed securities, that's the bond market, and then you've got the 10-year treasury, and that's treasury bonds. So you've got two different things here that we're talking about: the mortgage-backed securities, the 10-year treasury, the Fed funds rate. It's all connected, but they're not the same thing. Back during COVID, there was talk about when the Fed was going to lower the Fed funds rate to 0, and we got many funny calls about people wanting to know, can you get a home with a 0% interest rate? Well, the answer was obviously no. That's not the same thing. Just because the Fed funds rate went to zero doesn't mean you get a 0% interest rate on a house. So they are connected. What we also know right now, this is what nobody's talking about, is the mortgage-backed securities and that 10-year treasury. There's a big spread in between those right now, and it's a lot of fluff. And so when these rates start getting cut and things start changing, you may see a bigger drop than what makes sense. If the Fed cuts by 25 basis points, that may seem like, well, that's not very big. That's only 0.25%, but you could see the rates drop 0.5% or a whole percent just because that fluff is going down between where all those market indicators are.
Well, this is episode 13, and this is the most excited I've seen Monty, and the most animated. So it's exciting times. What do you think about all this, Terry?
Well, I think that we are definitely in for some turbulent times between now and the election, and potentially even after the election. And it looks like the stock market's finally gotten the message that the economy is not as great as everyone has been saying it is. I want to bring up one thing, actually a couple of things. So I attended a dinner Saturday night that Florida Senator Rick Scott spoke at, and he gave us a statement that I can't corroborate, but maybe Monty can. But, they say that the population current unemployment rate for the population, working class population right now is 4.2% or so. That means about 1 out of 25 working people don't have a job right now. But do you know what Senator Scott said? He said, do you know how many people age 16 to 64, which is the working age of people? Do you know how many of those are not working and not counted in the unemployment rate? He said, now, again, I didn't corroborate this. He said it is approaching 100 million citizens of the United States are not working right now, who are of working age and are not counted as unemployed because they're not looking for jobs. I think that is ridiculous. That tells you how many people are on the government dole. And in addition, that tells you that more than 1 out of 4 Americans who can work is not working. And they aren't even counted as unemployed. So if you take that into account, that just tells you how government spending contributes to inflation. Because if the government continues to send these people checks who are not working, that's got to come from somebody. It comes from thin air with the Fed printing money. It also comes from taxpayers. So that's money that's not going to contribute to the economy, because it's going to help people buy food and groceries and things like that, who are getting it for free because they're not working. So I thought that was an amazing statistic.
Yeah,
Monty,
that is.
go ahead.
I don't know the data behind that, whether that's supported by a report. We don't have that today. What we do have is somewhat similar to that. And if what you're saying is true, then this is even sadder to think about. But we did get some numbers on the people that are employed part-time for economic reasons. And that rose by 346,000 people to 4.6 million. That's what we have total, 4.6 million in July. These are people who would have preferred full-time work, but they were only working part-time because their hours had been reduced or they were unable to find full-time jobs. So these are people not in that 100 million. These are people that are hustling. They want to work full-time. They're just not allowed to. And so that's another indication that our job market is weakening. It's really, really sad when you think about the people that want to work can't do it, and the people that could do it won't do it.
Well, part of that trend is that people, a lot of employers right now are lowering hours to less than 30 hours, because then they don't have to pay for health care, correct? I know that California fast food restaurants have dramatically lowered the number of hours that people are working, because they don't want to, on top of the $20 per hour minimum wage. And if you've been there 5 years, you're not making $20 an hour, you're making $25 an hour. They're lowering their hours worked to less than 30 hours so they don't have to pay for the health care. Well, that's a huge expense. Now they've got to go on the public Medicare, and I think it's Medi-Cal in California. But that's another impact to the economy, is the fact that people no longer have health care provided by their employer.
Right.
Well,
Well, yeah, that is sad. Terry, I do, and David, I want to make sure we hit the home prices though, because that's a positive before we
okay.
get off the show, that we did get that data. And so we want to be encouraging about the home prices hitting that new record high. Now, this came from Case-Shiller's Home Price Index. That's considered the gold standard for appreciation. And it showed that home prices nationwide rose 0.3% from April to May after that seasonal adjustment. So that's breaking the previous month's all-time high. Home values in May were also 5.9% higher than a year earlier, following a 6.4% gain in April. So the FHFA, that's the Federal Housing Finance Agency's Home Price Index, they also reported that the home prices were unchanged for April to May, with prices at 5.7% higher than the previous year. Now, note that the FHFA does not include cash buyers or jumbo loans. So those factors account for some of the differences in those two reports. But what's the bottom line? The bottom line is the national home values continue to set all-time highs, and housing still proves to be one of the best investments, vehicles for wealth creation. The head of commodities for the S&P, this Brian D. Luke, he confirmed this. He said, the waiting game for the possibility of favorable changes in lending rates continues to be costly for potential buyers as home prices march forward. Luke added that the Case-Shiller's Home Price Index has appreciated 4.1% year to date, the fastest start in 2 years. So the train has left the station. You got to get on it. It's not going to slow down.
Well, let me talk about that too. That's a great point. So I'm old enough. I've been through the dot-com bust and the 08, 09 financial meltdown, which was real estate, stocks, everything else. To me, this sounds a lot more like we're going through the dot-com bust, which is the Fed is slowing down the economy, but real estate continues to thrive. I think that people, when things get risky, they pull their money out of the stock market and they start going for solid assets like real estate. And real estate continued to appreciate during the dot-com bubble burst because people said, I'm putting my money into something that's stable, which is real estate. And we don't have the subprime, the option arm lending that caused the real estate crisis in 08, 09. We don't have that. Lenders now, they lend based upon, for the most part, on solid buyers, on stable buyers. So we don't have all of that fluff where someone paid $500 and they own a house now, but before, like they had during the subprime era. We've got a much more stable real estate market. And so I think real estate is going to continue to appreciate, especially if we continue to get rates to drop. We know that values go up more as rates continue to drop because people can afford more house. And so they go out and start buying more houses. So I think we're in this era where real estate is the place to be because you can't, God's not making any more real estate. So I think that's a great place to go.
Monty, I'm going to put you on the spot as we're going to getting close to the end, because the thing that really matters to our members, and since Monty, you said you do have that crystal ball behind you somewhere on that shelf. I don't know where it is, but if we're speaking directly to our members, I really want you to maybe share with our members the next 3 to 6 to 9 months, if they're thinking about leaving. What's the difference? What's the upside of leaving in 3 months or leaving tomorrow? And what's the downside of waiting 6 months or 9 months? What could happen if you could give me like the good or the bad, even if it's just for the next 3 or 6 months, or if you should do it tomorrow. But if you could just speak directly to the members and look at that crystal ball and give them a really good perspective of what could happen.
Yeah, absolutely. Biggest thing is the appreciation. It's not the interest rates. You might think I would go with the interest rates and how they're going to drop. It doesn't even matter. The appreciation information is so much more important than the interest rates, because the interest can change. What's never going to change is that appreciation. You can't catch up. And so I have a really cool tool. If this is at all interesting to you, if you are at all considering buying a house in the next 2 years, I would say, call me so I can build that tool for you specifically. I'll send it to you so you can play with it and you can look at it. But it's the cost of waiting, and it will put it in terms of your specific situation. But I'll just give you a high level concept of this. If you were going to buy a house right now at $750,000, let's pick Knoxville, Tennessee, one of our favorite places to go. If you were going to do that right now versus in 6 months, if this is right and the appreciation keeps going like it is, then that house at 750 right now is probably going to be closer to 787,500, about 5% more 6 months from now as rates are starting to drop and there's more competition. So you just lost 37,500 immediately, no matter what, because you missed out on that appreciation. So even if you saved up a little bit more, even if the rates are a little bit lower, your payment may be higher in 6 months than it would be right now, even though rates were lower than at that time, because you're buying a more expensive house. So that's the way I would make it as simple as I can, David. Is it that appreciation matters so much. You're so much better off if you can catch that train and be on it when it's time to look up and see, hey, where are we in 2025? You'll be glad you made that decision.
Well, I have to say that to our members, I mean, we say this every week. You can call any one of us three. We're available. We talk to people that are relocating every day. This is what we do. And we can at least give you the advice, and we can show you how it's going to look, how it looks tomorrow, how it's going to look in 6 months. And if you haven't hit subscribe on our YouTube channel, you have to go to our YouTube channel or go to my YouTube channel. I have all these shows on my channel. Terry, where do they have to go to subscribe to the YouTube channel?
Just go to YouTube and search for Leaving California, and it has our Leaving California logo on it. So they can find it that way, and there's hundreds of videos on there.
And if you want, all you have to do is send us a direct message on Facebook in the groups, and we will respond to you, and we will give you that free counseling. Again, it's crazy. Episode 13 is in the books, but it's just crazy. And it seems like it's going to get crazier closer to the election. Terry, you keep talking about it, but it's not like it's done. We're just getting started, right, Terry?
I think so too, David. Last week, I was introduced to a Google search called Google Trends. I looked it up. Anyone can do this. Go to Google Trends, and it'll come up with the link, and you can type in, I typed in Leaving California. They go back all the way to 2004 to let you know the amount of searches for that, not the number, but the percentage, with 100 being the absolute most, the highest number. Well, last week I looked, and in May of this year, by more than twice as much, people were typing in Leaving California than they were during the pandemic. That trend has also continued this month. I just looked for the first couple of days of August. It's higher right now than it was during the pandemic of people typing in Leaving California. And I think I said this last time, I believe that after the election, things are going to really fall apart in California. And I'm not a doomsday, what do you call it? Doomsdayer?
Doomsday prepper.
Yeah.
No, I'm not. But I think California is going to double down on all the policies. They're going to say, look, we just aren't far enough left. They've been saying that for the 35 years I lived there. They just kept saying, all we need is more taxes. All we need is more regulation. All we need is more punishment for our taxpayers. And things will be utopia in California. And it just continues to get worse. So I believe those who pay taxes are going to continue to leave. We know that Elon Musk just took his remaining 2 companies out of California. I saw a statistic this morning that hundreds and hundreds of companies have left California. It's not going to stop anytime soon. They're not all of a sudden, I don't believe in this election, they're going to take a sudden right turn. And it would take a long time to turn Titanic around anyway, right? The iceberg is right in front of you.
Right.
I'm sorry, but you're not going to turn that ship anytime soon to where all of a sudden California is a conservative state where things are going better than they are now. And I think it's just going to continue to run right into that iceberg. And I'm only saying this so that people who are on the fence, call Monty and talk to him. Even if you're paying cash, by the way, even if you're paying cash for your house, call Monty, because he can help you figure out where maybe you want to deploy some of that capital. Maybe you don't want to pay cash for a house. Maybe you can buy some investment homes. I believe that real estate is the place to be long-term. And he can certainly help you with a plan that will work best for you and your finances.
Well, thank you everybody for tuning in, and our viewership is continuing to grow, and we appreciate you. The other thing we ask is we really appreciate you watching the show, but please share our show with other people that are thinking about leaving. Make sure you subscribe. Please like and comment. If there's other topics you want us to touch on, we will definitely hit those. This is episode 13. I'm David Berry. I'm your host. I hope you have a great week, and we'll see you next Monday. Take care. Bye-bye.